Imagine we are at a high-stakes poker game. Inflation is the dealer, constantly raising the blinds, making every hand riskier. Then AI walks in, playing perfectly, almost instantly seeing everyone's cards. We need to know who is bluffing and where the real edge lies before the game changes entirely. Hello, this is WarmInsight. Today, we're going to talk about how inflation and artificial intelligence are completely rewriting the rules of wealth creation and what smart money sees now. Leaving a like and subscribing is a huge help to us. Right now, the global economy is standing at a terrifying and unprecedented crossroads that most everyday investors simply do not understand. We are witnessing the collision of two massive structural forces that have never existed at the exact same time in human history. On one side of the battlefield, we have sticky, entrenched inflation that absolutely refuses to die down. On the other side, we have the explosive, untamed power of artificial intelligence, advancing at a speed that is shocking, even the engineers who created it. This is not just another normal market cycle, where you can buy the dip and wait for things to recover. The president of Goldman Sachs, John Waldron, recently issued a severe warning to the financial world. He stated clearly that inflation is the single biggest risk element threatening the global economy today, when the leadership at one of the most powerful investment banks on earth flashes a red warning light of this magnitude. It is time for us to stop looking at daily stock charts and start paying attention to the deep structural currents shifting beneath our feet. Most analysts spent the last year entirely focused on consumer prices at the grocery store or the gas pump. They celebrated prematurely when headline inflation ticked down slightly. But the smartest institutional money managers know that inflation has mutated into a deep structural beast. We are no longer just dealing with the temporary supply chain bottlenecks that happened a few years ago. We are dealing with a fundamental rewiring of global trade. Geopolitical tensions are forcing countries to bring manufacturing back home, which is significantly more expensive. Global supply chains are fracturing into competing regional blocks. These massive geopolitical shifts feed directly into permanent pricing pressures that central banks cannot easily fix. To truly understand the danger of this moment, we have to look back at the devastating economic lessons of the 1970s. During that decade, the world experienced massive energy shocks and relentless inflation that crippled purchasing power for an entire generation. Central bankers back then hesitated. They tried to avoid causing a recession by keeping interest rates too low for too long. This fatal mistake allowed inflation to become deeply embedded in the psychology of the public. People started expecting prices to rise every single month, so they demanded higher wages, which forced companies to raise prices even further to cover their costs. It created a toxic, self-fulfilling doom loop. It took the brutal intervention of Federal Reserve Chairman Paul Volcker, who pushed interest rates to astronomical levels, to finally break the back of inflation. Today, our modern central banks are terrified of repeating the mistakes of the 1970s. They are currently trapped in a brutal dilemma. They are caught perfectly between the need to cool down, rising prices, and the desperate desire to avoid crashing the economy into a hard landing, because inflation is proving to be incredibly sticky and resistant to their current policies. The reality is that we are facing a future of higher for longer interest rates. This changes the mathematics of every single investment on Earth. When borrowing costs climb, the era of cheap money dies. Companies that rely on massive debts to fund their operations will face crushing interest payments. Growth expectations across all developed markets will inevitably dip. We are already seeing this violent repricing play out in the bond markets as yields spike to reflect the new dangerous reality. A clean, painless resolution to this crisis seems mathematically impossible at this point, while the suffocating pressure of inflation acts like a heavy blanket over the economy. The rapid advancement of artificial intelligence has arrived, like a bolt of lightning. This technology is a massive double-edged sword that is creating unprecedented wealth for a select few, while introducing terrifying systemic risks for everyone else. We are currently watching the greatest capital expenditure boom in modern history. The sheer demand for artificial intelligence infrastructure has pushed chipmakers into the exclusive $1 trillion market capitalization club. Companies like Samsung, Micron, and SK Hynix are experiencing a surge in demand that defies all previous historical models. They are the companies manufacturing the critical high-bandwidth memory chips that serve as the physical foundation for the artificial intelligence revolution. To put this in perspective, entire supply runs of these advanced chips are completely sold out years in advance. The smartest money on Wall Street realizes that this is not just a speculative bubble based on empty promises. This is a massive multi-trillion-dollar build-out of physical infrastructure. Data centers are being constructed around the world at a breakneck pace. Tech giants are engaged in an existential arms race to secure computing power because they know that whoever wins, the artificial intelligence war will control the future of the global economy. This level of investment points to a potential massive productivity boom. If artificial intelligence can drastically reduce the cost of labor and dramatically increase corporate efficiency, we could see a golden era of margin expansion that offsets the pain of inflation. However, there is a dark and terrifying side to this technological leap that the mainstream financial media is largely ignoring. We are now seeing artificial intelligence agents actively trading on retail platforms like Robinhood. These are not just simple algorithms executing basic commands. These are complex self-learning systems, making split-second financial decisions with real money. This introduces a level of algorithmic risk that our financial markets have never encountered before. Imagine millions of artificial intelligence bots analyzing the exact same data points, reading the exact same news headlines, and executing buy or sell orders at the exact same millisecond. We are staring at a Wild West scenario where market stability is constantly under threat. A minor piece of bad news could trigger a cascading avalanche of automated selling, wiping out billions of dollars of wealth in the blink of an eye. Regulatory bodies are completely unprepared for this reality. They are scrambling to understand how to protect consumers and maintain market integrity when the traders are machines. Furthermore, the race for artificial intelligence dominance is no longer just a corporate battle. It has become a matter of vital national security. Geopolitics plays a massive role here, as superpowers actively restrict the export of critical semiconductor technologies to rival nations. This impacts tech sector, regulation, and international trade agreements on a profound level. We have entered a new era where technological leaps create immense wealth, but also bring unprecedented systemic risks. Our entire investment framework needs a complete overhaul. Think of the global economy right now as a complex orchestral piece. Inflation is a rogue percussionist, speeding up the tempo wildly. The central banks are the exhausted conductors, struggling to keep the ensemble in sync. And artificial intelligence is a completely new, powerful instrument that is capable of creating beautiful harmony or absolute catastrophic discord. To survive this chaotic symphony, we must understand the fatal behavioral flaws of the retail investing herd. The real story of wealth creation always gets lost in the deafening noise of the crowd. Every day, retail investors are bombarded by clickbait headlines, promising easy, effortless wealth. Articles claiming to reveal the one secret exchange-traded fund that will set you up for life are nothing more than classic bait, designed to trigger the fear of missing out. We see this exact same destructive behavior with meme stocks and highly speculative digital assets. Uninformed retail investors are desperately chasing the next big thing, pouring their hard-earned money into assets they do not fundamentally understand. When a heavily promoted Bitcoin proxy strategy suddenly sinks, it violently spooks the inexperienced investors who jumped in at the top. This leads to massive panic selling and devastating financial losses. This endless, tragic cycle of chasing explosive gains and then bailing out at the absolute bottom is a constant feature of the financial markets. The shiny allure of artificial intelligence makes this psychological trap even more dangerous. The promise of automated agents trading for you appeals to the deepest human desire for effortless wealth. Without hard work or discipline, people become completely blind to the underlying catastrophic risks. It is the exact equivalent of everyone in a crowded room rushing to buy the same losing lottery ticket just because they heard a rumor that someone else won big last week. We know better than to ever follow that panicked, irrational crowd. Instead of chasing the herd, we must carefully study exactly what the smart institutional money is doing behind closed doors. The contrarian playbook is actively being deployed right now by the greatest financial minds in the world. While retail amateurs are busy gambling on penny stocks, the real smart money is executing two very specific strategies. First, they are taking the inflation warnings from institutions like Goldman Sachs incredibly seriously. They are not waiting for the government to save them. They are actively tearing down and rebalancing their entire portfolios to survive a high inflation environment. They are aggressively seeking out true inflation hedges. They are deeply scrutinizing corporate balance sheets to find companies that are extremely sensitive to rising interest rates, and they are eliminating them from their holdings. The holy grail for smart money right now is pricing power. They are hunting for robust companies that possess the unique ability to raise their prices without losing their customers. These companies generate massive, predictable cash flows, regardless of what the broader economy is doing. Second, institutional giants are looking far beyond the superficial artificial intelligence hype. They are completely ignoring companies that just slap the word artificial intelligence onto their press releases to artificially pump their stock price. Instead, they are searching for absolute sustainable competitive advantages. For example, when a massive enterprise software company like Salesforce begins strategically hiring for highly specific, specialized artificial intelligence engineering roles, it signals a quiet, calculated approach to integrating the technology into their core business model. The smart money investigates these fundamental operational shifts. They are also paying incredibly close attention to incoming regulatory crackdowns as government agencies begin to aggressively scrutinize prediction markets and clamp down on insider trading. The rules of the game are shifting. Clarity from regulators will destroy some business models, while creating massive new opportunities for others. This game is strictly for those who understand the complex rules. It is about finding real, tangible, cash-generating value, not just chasing perceived momentum. Think of the smartest investors as grandmaster chess players. While amateurs are distracted trying to capture meaningless pawns, the grandmaster is quietly positioning their most powerful pieces for total future control. They anticipate several moves ahead. They never just react to the news. They plan for it. So how do we practically apply this grandmaster strategy to our own capital? We are currently navigating what we call the generational bargain. The overall market sentiment right now is a highly delicate balance, characterized by a deep, underlying nervous bullishness rather than outright extreme fear or pure unadulterated greed. The relentless, staggering innovation in the technology sector is fueling massive optimism. We are seeing pockets of extreme greed in very specific semiconductor segments. However, this wild enthusiasm is heavily tempered by persistent, terrifying anxieties. Investors are constantly worrying about sticky inflation, destroying purchasing power, central banks, making a catastrophic policy error by over-tightening interest rates, and the unknown, long-term devastation that artificial intelligence automation could unleash on global labor markets. This injects a palpable, heavy sense of caution into every trading day. Because smart money is actively hedging their bets, we are witnessing choppy, volatile trading sessions, characterized by sudden, violent sector rotations. Investors are constantly weighing the dream of explosive growth against the very real nightmare of a deep recession. To survive and thrive in this treacherous environment, the WarmInsight panel recommends a highly disciplined 55-35-10 asset allocation seesaw strategy. Deploying capital today requires an incredibly nuanced approach that perfectly balances aggressive growth opportunities with ironclad defensive positioning. We allocate 55% of the portfolio strictly to high-quality stocks to capture the transformative wealth generating power of artificial intelligence. We target thematic funds like the iShares Semiconductor ETF or the ARK Innovation ETF. These vehicles provide concentrated exposure to the companies actually building the future, but they must be managed with strict, emotionless risk management protocols. We then allocate 35% of our capital to safe defensive assets, designed to act as an indestructible shield against persistent inflation. This involves taking strategic positions in broad commodity exchange, traded funds, and real estate investment trusts. Commodities like energy, metals, and agriculture physically increase in value as inflation destroys paper money. Real estate provides a tangible asset backed by rising rental yields. To further reinforce our defensive wall, we look at consumer staples and utility sector funds. These are the companies that provide the basic necessities of human life, offering profound resilience during severe economic downturns. Finally, we hold a strict 10% allocation in pure cash. Cash is not trash in a volatile market. Cash is financial ammunition. It is the dry powder necessary to aggressively buy the fear when the market Inevitably, panics and high-quality assets go on sale at massive discounts. Beyond simply choosing the right assets, we must also master the mechanics of global portfolio construction. The current economic landscape demands a rigorous mathematical assessment of domestic versus international exposure. The United States market, particularly its massive technology indices, continues to demonstrate absolute global leadership in innovation. This makes American markets the undeniable cornerstone for any growth-oriented portfolio, even though these stocks are currently trading at exceptionally high valuations. However, ignoring the rest of the world is a dangerous mistake. International markets, particularly select emerging economies, and dynamic regions across Asia, present incredibly compelling value opportunities. If the United States dollar begins to weaken and global inflation starts to moderate, these international equities could massively outperform domestic stocks. Europe is a much more complex puzzle, as the continent is still violently grappling with long-term energy security issues and stubborn regional inflation. Europe requires a surgical, highly selective approach rather than broad investment. A truly balanced world-class portfolio might slightly overweight the United States to capture stability and direct artificial intelligence exposure, while strategically diversifying capital into international value plays to capture the massive upside potential of a global economic rebalancing. The final and perhaps most important piece of the Titan playbook involves mastering survival mechanics. In an environment characterized by extreme volatility and sudden drawdowns, utilizing dollar cost averaging is absolutely indispensable. Dollar cost averaging forces you to buy consistently over time, regardless of whether the market is up or down. This powerful mathematical tool completely removes human emotion from the equation, smoothly averaging out your entry points, and completely mitigating the devastating impact of trying to perfectly time the market. Beyond consistent buying, maintaining that strategic cash reserve we discussed earlier is the ultimate key to opportunistic wealth building. When the herd panics and sells everything at the exact wrong time, your cash reserve allows you to step in and buy incredible companies at generational discounts. You must also regularly rebalance your portfolio to ensure your asset allocation never drifts away from your strict risk tolerance. If your semiconductor stocks double in value, you must have the discipline to trim those profits and reallocate the capital back into your defensive assets. You absolutely must avoid the fatal trap of concentrating your net worth in highly speculative, unprofitable artificial intelligence plays. True wealth is preserved through relentless diversification across multiple, non-correlated sectors and asset classes. To protect your downside, you must implement strict stop-loss orders on your most volatile positions. This ensures that a small, manageable loss never spirals into a catastrophic portfolio-destroying event. Capital preservation must always remain your absolute highest priority. Amidst this ongoing global uncertainty, the VIP action plan for the coming months is clear and highly specific. Your first primary action is to aggressively initiate or increase your exposure to artificial intelligence-centric semiconductor funds on any significant market pullback. We are not buying blindly. We wait for a strict mathematical trigger. If the NASDAQ 100 index closes below its 50-day moving average for 2 consecutive days, that is your signal to deploy capital into the semiconductor space. Your second primary action is to vastly increase your allocation to broad-based commodity funds or inflation-protected securities if the macroeconomic data flashes red. Your specific trigger here is the official Consumer Price Index report. If core inflation, which completely strips out the volatile prices of food and energy, prints above 4.5% for 2 consecutive months, it signals that inflationary pressures have become deeply entrenched in the system. That is the exact moment. You aggressively buy commodities to protect your purchasing power. What you absolutely must not do is blindly chase unprofitable companies or meme assets. Do not throw your money at any stock just because it has the word artificial intelligence in its name. Extreme volatility will ruthlessly erode your capital during the next inevitable market correction if you do not perform rigorous fundamental analysis and maintain proper position sizing. In times of profound economic and technological shift, disciplined patience and a relentless focus on long-term structural trends, rather than reacting to daily noise, are the true anchors of wealth preservation and explosive growth. History clearly shows us that periods combining high inflation and wildly disruptive technological advancement, often breed intense, terrifying market volatility. We saw this exact same pattern during the 1970s energy crisis, when it collided with the dawn of the personal computing revolution. These chaotic periods destroy the unprepared, but they also lay the fundamental groundwork for entirely new industry leaders to emerge and generate massive generational wealth. While the specific details of today are different, the timeless principles of adaptation, emotional discipline, and discerning true value through periods of maximum change remain the ultimate keys to success for astute investors. We couldn't fit all the deep dive details and practical strategies into this video,